Warning, this is all financial advice. You can invest in any way that will make you feel comfortable. This is just a full breakdown of the stock to help you invest into a company that will help you grow your portfolio for the long term. Thank you.
It's time to hone your skills. You'll certainly need it.
Hello guys, my name is Kool-Aid Man 100X. Welcome to Black Money. How you guys doing? Black people, listen, we're going to be jumping into and reviewing General Motors, which is GM. I'm going to be jumping to this company and do a thorough analysis and breakdown. So what we're going to be looking at first is, does this company pay dividends? Because we want to make sure that we're putting some in the company and we're getting some back out of the company. Let's check and see if they pay dividends. And General Motors does pay dividends. They pay a quarterly dividend for 18 cents a month, which is kind of low, but you can still be durable. But the quarterly is what turns it off for the dividends. So as we see here, we go to the dividend slide. They actually pay quarterly, 27% payout ratio. They stay between the 18 and 15, but you can see they actually gradually going up. So that's pretty good as well. So that's not bad. 25% dividend growth, which is pretty decent, I would say, in the long run. So that's actually not bad. The first thing we're going to be looking at next is the charts. So what I do for my charts, I actually look within the 6 months, 1 year, and a span of 5 years and max. So let's jump into these 6 months here. So we can see the key components of 6 months where they had a volume of 4.72%. And we can see within here of January 26, they had a volume of 24 million, which would actually equate to 8.75%, which is decent. But they took this big dip here at 76, which will be at 5.47%, which is 7 million. So they actually took this deep within that 6 months, and they took another dip here, which adds them at a negative 4.45%, which actually put them a little bit higher with a key component on a volume of 4.83%, which had a volume at 8.1 million, which is decent, but this uptick is actually bringing them up and down. It's very volatile, so that's not good. So let's look into the 1 year. They got actually a couple of points here. From the first point here, they actually had the 5.73%. As we can look here, is 87.67%. Then when we look here, we're looking at the 14% increase with 44 million. Then we can look at here, which is 80.75%, and which the volume of 24 million. Then we can see the 5.47%, which is 7.2 million. So they're taking dips. So let's look at the 5-year span here. So we can see the dips actually change. So we see a key component. They took a negative 24.74% with 123 million of the volume. Then we see in here with 11 point per, plus 11% up, which is 88 points. So it's like the volume is actually dropping in. It's like a volatile state. So they actually got 200 million, which is 14.83%. So we took an uptick here, which should actually add that to 98 million, which is 19.32%. Volume with that 98 million. So we look at the max overall of the company, no hits over here. So we're looking at this 99 million, 33%, which is a negative 12.74% earlier. So we took that 11%, 88 million, and 200 million, 14.83%, which is around 19.32%, which is, I would say, decent for a company like this. Actually taking a gradual of the uptick of 144.2%, which is the max of the 45.33%, which is decent. I would say General Motors came a long way with what they was before. I think it was like $18 a share, so actually came up pretty well. But I really think they're going to start dropping drastically in the future. But I can see it. Their dividends is actually taking a hold on what they're paying for too as well. So they do pay dividends, quarterly dividends to the high, low, which is decent. They're around the 80s. The market cap is 74.25 billion. Decent average. The volume 6.52 million. A lot of people not knowing. And the PE ratio is 33.36%. Number of employees 156K, which is crazy. For this company to have an 83.42%, or $83.52 a share, they only got 156,000 employees. So once again, where did the money go? So that's my next thing. We're going to be jumping into the cash flow, which is the overview. A lot of people don't know about this. When you look into a cash flow of a company, you want to look into their finance. So then you want to go to their cash flow. Then I have a list of things we're going to be going over and actually looking into the company a little bit more deeper and see how this company actually run correctly. Is they making money, losing money, or they using people, basically. So let's look at the net income. The net income for the 2025 is 1.90 billion, which is cool. 1.33 billion, negative 3.31 billion. This is crazy. They had a high good season within that 2025, and they took a beast hit in December 2025. I believe that's when the workers was on strike, and they went back up 2.63 billion. So they actually made up out of a negative than what they put in. Decent, but this is bad. The next thing we're going to be looking at is cash flow operation, 6.91 billion, 7.71 billion. So the operation is taking a big hit. In March is 2.9 billion. Why is that? Why did operations go low? You spent almost 6.80 billion. So I guess that's when the firing came, when they actually took that hit, which is, I guess, understandable. I would say, I don't know. So let's do the change in inventories. So they never changed the inventories in the last year, but the inventory is actually 6.26 million. I guess that's new items that they added, or they're funding something else. Interesting. The next one is going to be cash from investing. Let's look at that. So we're looking at something from the cash and investing, negative 6.67 billion. They're still in the negatives. They just got out of it this year. So they've been in the negative for the whole year. So they never had anything to invest in. So they actually invest into their own company and other things as well for 632 million. That's not good. That means your company can't be sustainable of outside investing to run the company. So y'all not actually making real outside cash, I would say. Let's look at your finances. The cash from financing. Cash from financing, 1.22 billion, negative 5.29 billion, and negative 5 billion, then a negative 3.69 billion. What are y'all financing for y'all to be in the negatives this high? And you're trying to work your way out of it, but y'all done dug yourself already 5.29 billion out the hole, and y'all just coming out of it, but y'all got a long way to come out of it. This is billion, it's not millions or thousands. This is a very big hole to be worried about in this company that's financing. Whoever financing our company or insuring things, this is a lot of money to put into financing. That's not good, I would say. Free cash flow. The free cash flow is 3.2 billion. Right. Okay. 8.89, 13, 2.24. That's not good. Where did all this money go for y'all to have not free cash flow? That's not making any sense right there. So y'all came up to literally 13.2 billion. Y'all dropped down to 2.24 billion. Where did this money go? It's not making any sense. So your unlevered cash is unlevered cash you got in an account that y'all don't really touch, which is going to be 3.40 billion, y'all got the same. That's not good. So where did this money go? Yo, what's up, guys? This your boy Kool-Aid Man 100X. I want you to hit the link in the description below for my Zero Investment books. We have a quick sale going on for $7. Link will be in the description below or in the comments below as well, so you can get a chance to get the $7 deal and other things that you want to learn how to invest and take your investing to the next level. So I hope y'all enjoy. I'm gonna catch you guys there. And it was at 13 that you had unleveled. So you took this money out, use this money too, and the cash flow that you got. This is where you end up with. I would say that's not good for a company to actually run it, but let's check the balance sheets. The balance sheet is really what's going to tell us all about your actual company and reflections on what you're doing as far as your inventory and stuff that you sell and stuff that you run or create. So let's look into it, people. The inventory. So we're going to look at the inventory. You got 15.45 bill, 15.45, 14, 15.59. So y'all do got very good, decent inventory, which is decent, I would say. Not bad at all. We're going to be looking at the total current assets. Now, I actually want to look into this. Total current assets is 2.60 billion, 5.13, 5.4, 5.15. Now, this is interesting. Y'all got so much in assets, but why are y'all not investing the assets? Probably because y'all got landmarks and y'all trying to use y'all company as the asset. I'm thinking that's where this is coming into being with really understanding how your company actually runs. So y'all really don't have any current assets. Y'all using General Motors as the asset, which is the cars or parts that y'all create for the cars and stuff like that. So looking at that to be I would say, a problem, but not a problem, but a problem. If that makes sense. I don't know. But your total current assets is this, which are y'all very roughly in the billions, and your other current assets is low. I'm not understanding that. So y'all using our company as the assets. Don't get me wrong, which is cool, but I wouldn't do that in a way. But you can, as far as GM actually making money and making this the only manufacturer in the United States, this can be relevant to be good to have, but this would have to be a flowing cash flow company, because I don't understand why y'all cash flow is so low and y'all unlevered cash if y'all have the total assets to make the money. It's not making any sense. Cash from investing. Interesting. So it's just more and more expenses, I would say. We're going to look into that too. Where you actually put into that, but it's really not making any adjustment to it. So the inventory is high, the total assets you're using as the company, but it's not really making any sense for your, I would say, your asset, which is General Motors, I guess. Which don't make any sense, but either or, I guess. All right, so we're going to look at the total occurring expenses. This is where we're going to get into the nitty gritty of how much this company costs to run. So we're looking at, you're starting at 28.42 bill, 29, 40, 23. Then y'all uptick to 30.51 billion. How did y'all go from this to this within a year span? Not making any sense. So y'all spending more money in the company using your unleveraged and total asset cash to actually make the company run. I don't understand that, GM. When you have people out here that can really invest into the company. And what I don't understand about GM is why they don't get part of the company instead of a stipend. Why don't you give them shares? You give them shares into the company and they can put more money into the company and actually make the company grow. Or actually more workers can actually get paid, and you can fluctuate that cash to actually come out. Just saying, GM. That's all I'm saying. Give your people some shares in their contract, not just a contract and a stipend. Because these expenses are just going to grow over time. It's going to cost you more to run GM than it is selling something from GM. So I believe that's how that's supposed to go. I guess you gotta make money to make that, but that does make sense to do. Total other long-term assets, which is 8.4 billion, decent but low. Why your current expenses is higher than your long-term investments? It's not making any sense. So if you're investing outside the company and your asset is the company, so how are your long-term investments making the same amount that you actually incur the expenses to run the company? That's not making any sense either. So you have to take that into account too as well. Long-term investment assets is not good, but let's look at your total assets, which we can see here, which is 2.89, 38. We're going 89, 88, 81. You're going down. What are you? Okay, GM, what are you doing as far as the total assets that you're actually, you starting off within a year, you're going down within a year. So every year your total assets, are you taking the total assets out of your company to put back into the company to actually incur the expenses to actually make up for what you actually being charged to run the company? That's not good to do at all. So you have to take that into account. That's, ooh Lord, that's not good. So what is GM actually running off of if you really want to take it into account? So I always throw this in here too in the videos, is that the total equity of the company is 68.46 billion. It dropped down from that to 64. This is within a year. Not good. Price of books, 1.2. Lord. Return on assets, only 3%. Return on capital, 5%. Return on equality, 6.92. Ooh, God, dog. Shares outstanding, 9 of 2. So y'all sharing a company within a company, I guess. Whatever makes sense into your world, I guess. So, it's starting out to be not good. Long-term debt. Oh my God. This is not good. Y'all are starting out at 15. Y'all are still in the hole for debt. Long-term leases, decent. I can see y'all, but this, how y'all get a 1.65 bill lease term? What type of why is GM leasing locations? Why don't you just buy them? Why that uptick in 1.65 billion? And now y'all started off at 3.91 billion, which it should have just stayed this number. Within a year, y'all racked up 1.65 billion in leases. I guess it's when y'all changed it, like, oh yeah, we losing money. In my instance, that was just a waste of bread, but whatever. Let's look at your earnings. So for GM to do actually good, they only had one bad learning, which is their revenue is down like 1.6%, but that was in January 2026 of this year. So they actually took a little bit of a hit, but it's 1.61. So they actually been doing good for the past couple of years. So I would say for the past year or two, they've been doing great. So they actually took an uptick in the company, but them contract renewals coming up. So you might see this stock tank. It's going to tank. It's not going to be, if my calculations is right, I'm thinking this is going to drop back into when General Motors was like $18, $20. I think it's going to drop back into $20 because right now we got those contract renewals going to be coming up, and yeah, a lot of people going to want more money, and y'all been making a whole bunch of debt. So I guess. So I'm going to be looking into the key issues with this situation too as well. So the tariffs exposure and the impact of GM, which is profit margins. So I'm going to look at their bullish and their bearish. So what I like to start off is with the bullish. GM has demonstrated the resilience by rising up for the fiscal year of 2026, a profiting of 13 to 15 billion despite raising the tariffs cost. So they have to outsource their items outside the country, so they're actually paying tariffs. So I guess they're making double out of that. However that works, the company is outshoring. You see what I'm saying? Because they're outshoring their investments. So what are y'all investing overseas? And the supply chain adjustments to affect the migrated strategy for the long-term margin. So basically what y'all doing is y'all buying stuff overseas, and then y'all investing overseas for these products to actually work in the United States. So why are y'all not manufacturing your own products to lower the actual cost? Because I believe GM is actually pocketing this money and not paying their employees. There you go. So I believe that they don't offer these contracts with shares. They offer these contracts with just payment stipends, which is for these type of jobs, you just sign up for your amount of years and you get paid out what you're supposed to get paid out within that, because you're guaranteed your position. So it's like a security. So basically whatever, but no. But the Barclay Fast GM for cost structure is absorbing 3 to 4 billion in gross tariffs for EIC. They're absorbing it because they pocketing what they're actually spending. So the consecutive year, simultaneously funding 1 to 1.5 billion of unshored investments, won't pay back until 2027. An analyst warns tariff pressure and margin before the volume actually recover. So they're, how can I put this? They're investing in their own company. They're actually buying Oh my God, they're trading GM. If you want to look at it that way, I'm trying to put it in layman terms for you. They're trading GM, making the money off what they invest into their company because they're paying tariffs to pay tariffs. So in other words, how can I put this in simpler terms? It's like they're using debt to pay off debt to pay debt. I don't know what else to explain with that, but overall, I guess. But if you want to go here, you can go to Perplexity. They actually have sources that you can read to as well. So you can see here for 52 REITs or 41 to 87, they absorbing the cost, but they pocketing that money. So that's why if we go back to the situation, this is why their dividends are so low. They're pocketing that money and giving you the scraps. And it took 3 years of growth, bro. They were at 2022, 90. 9 cents a share of dividends, bro. And you get paid quarterly, so every 3 months. So this is September, December, March, April. So they're just hitting 18%. So this is why the shareholders is 13%. Then this is why the growth is 31%. So they can look like they're growing, but they're not. They never grew within the last 3 years. They pocket all that money. As you see here, this is live. So
what is an analyst consensus? Analyst consensus refers to the average of different analysts' estimates about a stock's or security's performance, particularly regarding future earnings or financial metrics. It is an aggregated estimate that helps investors gauge market expectations and is crucial for financial communication. This consensus can also assist in identifying forecast errors made by management.
Dollar Tree now. So we're going to be looking into what I like to call what is the analyzed consensus for GM. So, yeah. So if you look at the analyzed consensus about this, they look at this as a moderate buy, which I do agree it is a moderate buy because you don't know the volatility of GM, General Motors, as a company for this to be at the prices at. This is just like, oh man, GM going up, GM going up. No, it's not. It's not going up because this is just they're behind a lot of debt, but they're doing pretty good profit wise. But where's this profit going if your current assets is high, your debt is high, you have no outside investments, you're insuring all of your company within finances, you paid almost 1.6 billion within a year in leases. So what are y'all doing with the profits that you make and the money? Then they they got the nerve to say their average price target is $94.65. No. No. Only buy General Motors at the low because it's going to be at the high later. Always catch it at the low. I would say if you can stomach paying General Motors instead of 83.24, I believe, because if we look into the max year, I think their lowest was 20. I will wait for this to happen. Yep. $20, $21, anything. Yep. That's the lowest they went, $20. I would not buy this share till it hits $20. And I believe it's going to hit $20. I don't believe it's going to be no $83. If you buy it, yeah, I would buy one share. That's it. And just let it sit because you never know it's going to go down, it's going to go up. But at this price now, no, this is going to be a waste because I'm telling you now, you see, we up 50, it drops. It's up, it drops. It's not worth it. It's not. That's why I say it's a moderate buy. Yeah, you can get in on the rush now if you had it before, but now, no, I would not do that. I would not buy this company at a high price like that. I would buy this company at a low price when they hit that $20 mark again, which it will happen. $20 will be hitting that pretty soon. So that's pretty much it. I hope you enjoy. I'm going to catch you guys in the next video.